Hi friends, I'm Chelsea Grayson coming to you once again from the Office of the CEO. This is my show where I can help you be more successful in your current career, and I can also help you successfully transition to a new career. So last week we talked about corporate risk, how to de-risk, how to preempt risk, how to manage risk, and we talked about a few examples of some risks that I see on the horizon for the coming 1 to 5 years. Today, I wanted to talk to you a bit about the various types of insurance policies that can help you de-risk. There's lots of risk that you're never going to be able to prevent. Some of it is just totally outside of your control, like a natural disaster. Some of it is unpredictable. Some of it, no matter how much you guard yourself or build up barriers, some bad actor is still going to get within the four walls of your company. And so it's prudent that out of an abundance of caution, you purchase certain types of insurance policies across the board, no matter what kind of business you run. Now, before you stop watching this episode, I know insurance sounds like a very boring topic, but trust me, it's not. Insurance is actually a sector that evolves every year, real time. Insurance actually evolves in parity with the evolving market. So for example, we'll talk about cyber insurance momentarily. Cyber insurance is something that didn't exist just a decade ago. Although there were cyber attacks, the thing called the internet and websites had already been invented. There were cyber attacks, of course. But the insurance industry had to take some time to evolve along with the market to realize that companies were going to have cyber attacks no matter what, and they needed to shore up their walls with cyber insurance in order not to completely lose their ass to the extent that there was a cyber attack. So that's what I mean by how exciting the insurance market can actually be. It evolves alongside of industry, alongside of business need. It is definitely not a static sector. So let me get to a few interesting and useful types of insurance that you might want to consider to the extent that you're running a business, to the extent that you own a business, or frankly, to the extent that you run a business division and you're high enough up in the organization where it really matters to you that the business could be materially devastated by some sort of a disaster or an attack. And you feel like it's prudent to advise the C-suite, including the CEO and or the board, as to various types of preparedness that it can engage in to the extent that it buys insurance policies. So some of the more boring ones, but I do want to get them out of the way because they are necessary for any business, generally speaking. Vehicle insurance, right? To the extent that anybody has a so-called company car. Those are a bit a thing of the past, but a lot of times you will get vehicle insurance, even to the extent somebody doesn't have a company car, but they drive a lot for their particular job function, like they're a traveling sales rep, for example. And of course, there's an important footnote here that I do want to mention along the lines of vehicle insurance. And it's the Uber example and the Lyft example and the various other gig economy examples. They have things like vehicle insurance, notwithstanding that most of the folks that work for them are independent contractors. They are not actual employees of the company. So that is something that I want you very much to keep top of mind, that even to the extent that you maybe mostly have independent contractors working for you, to the extent you've got outside advisors, to the extent you've got mostly consultants, you don't have many employees, there are still all sorts of insurance protections that you still might want to consider. Uber couldn't survive without its insurance that it's got on each of its drivers. We all read in the headlines all the time about incidents that are involved, whether it's the plain vanilla car accident, whether it's somebody spazzing on an Uber driver, for example, or whether it's an Uber driver completely going rogue and attacking somebody else, right? We hear all sorts of in the margin incidents, and that's something that Uber absolutely has shored up when it comes to insurance, and not just vehicle insurance, of course, all different kinds of insurance. But I did want to make sure and take the time to point that out to you, that just because you have independent contractors or just because your organization is part of the gig economy doesn't mean that there aren't important insurance packages that you ought to get. Professional liability insurance, again, another one that sounds boring, But this is to the extent that you have any lawyers at all that work for your company, in-house general counsel, in-house corporate counsel. If you just have paralegals, you absolutely want to, at the very least, in respect of professional liability insurance, you want to make sure and get legal malpractice insurance. That comes within the bucket of professional liability insurance. So you for sure want to get that, because they can be sued just like any other lawyer, and you absolutely don't want to be on the wrong side of that. By the way, the folks that are likely to sue them is the organization itself, or people that are fiduciary beneficiaries of the organization, shareholders, investors, debt holders, what have you. Those folks have deep pockets, and you want to have insurance to defend against those sorts of lawsuits. Property insurance, I hope this goes without saying. That's not one that I need to spend a lot of time on, but it's certainly something that every corporate entity should have. General liability is also something that, again, sounds very boring, but this is the insurance that takes care of the so-called slip and falls, the sort of plain vanilla everyday incidents that can happen and completely devastate a business if it goes awry. Somebody slips and falls in your little mom and pop store, they sue you for $2 million for injuries, and you're done, you're out of business. But if you have general liability insurance, you pay a small deductible, the insurance company takes care of that, you're on your merry way. And by the way, nobody is as much of a shark as an insurance carrier in that situation. They will absolutely do everything they can to minimize the loss and damages of that lawsuit. So it actually helps deter, in some ways, plaintiffs' lawyers from suing a company when they see that there's a really hard insurance company on the other side. On the flip side of that coin, of course, if they know that there's an insurance bucket, then they'll feel better about pursuing because they know they're going to get some sort of a settlement. But again, that's no matter to you because that's your insurance policy. You pay your deductible or your self-insured retention. You're out of there. The insurance company takes care of the rest, and you don't have to think about it again. I do want to talk to you about business interruption insurance. This is extremely important, especially if you're in a geography that succumbs to natural disasters here and there, whether it's hurricanes, whether it's other sorts of storms, whether it's earthquakes, mudslides, fires, what have you. You absolutely want to have business insurance, which generally takes care of things like theft, so breakage if you're a retailer, and natural disasters. So business interruption insurance is a very important one. So EPLI insurance is also a very important one that a lot of folks skip because they think general liability covers it. EPLI is employment practices insurance. So this is when someone sues you for an employment or labor related claim. So this is anything from I was harassed on the job to I was fired and it was discriminatory to a labor organization, a labor union is attempting to unionize or file some sort of a claim, an NLRB claim. EPLI can cover all of that. All you need to know about EPLI is that the E stands for employment. That will always trigger you. So listen, the cost of doing business generally in America is that you will be sued by a disgruntled employee. That is absolutely just a fact of doing business. It's the cost of doing business. And the way that you can minimize that cost is by having a good, solid EPLI insurance policy so that, again, you just pay the deductible, you're done. The insurance company negotiates with the former employee to the extent it's a wrongful termination case, and you never have to think about it again. And they're the ones that negotiate really ironclad non-disclosure agreements as well, so you never have to hear about it again either, and nobody else will. D&O insurance, that's directors and officers insurance. So that, of course, and we've talked a little bit about the importance of sitting on boards as you get to a particular point in your career. Listen, as a director, you're always going to want to ask the company whose board you're sitting on, what does your directors and officers insurance policy look like? What is the deductible, or is there a self-insured retention, which is different because you have to put that up front instead of a deductible, which you pay on the back end after the claim's been settled. What are the limits? Exactly what are the exclusions? You definitely want to know this because companies are sued all the time by disgruntled shareholders, by other folks who feel that they've been damaged by the entity. And a lot of times they sue the directors and the officers. This is where it comes into play as you as an executive at the company. They sue the directors and officers, the D's and O's, individually. And you sure don't want a mortgage, you sure don't want to put a second mortgage on your house, do you? If someone sues you individually just because of something they're alleging that you did in your capacity as a director or an officer of the company. You always want to have an insurance policy to look to. And on the side, you want the company to indemnify you, but that's a conversation for a separate episode. So make sure that there's directors and officers insurance so that the directors and officers can dip into that bucket and they don't have to dip into the EPLI bucket, which you want the organization to be able to rely on exclusively. So that there's two different towers of insurance here that we're talking. The organization goes to EPLI, and to the extent somebody sues a D or an O individually, they go to the D and O insurance. So you'll also want to, as I referred to earlier, you will want to get cyber insurance. So this is a relatively new beast, maybe within the last, call it 5 to 7, maybe almost 10 years. We all know that there's cyber attacks against organizations. As I sit here recording this episode today, Facebook, just disclosed that they had yet another cyber attack where all sorts of private information was released. And you're going to have this no matter how well you shore up the walls of your company. Facebook is a tech company, right? And they always talk about privacy first, and even they get hacked every once in a while. That's going to happen. That there's going to be lawsuits that come from that, usually the big scary class action lawsuits. And the government is probably going to investigate if you're a big enough company, and to the extent that they find that you were negligent, they'll assess penalties. Well, you definitely want to minimize your damages there, and you can negotiate a cyber insurance policy with your insurance carrier. These aren't perfect yet. It's still an evolving animal, like I said, but they're getting better and better every quarter. The deductibles are coming down, the coverage is getting broader, the process by which you can become eligible for a policy like this is getting a lot looser. The insurance companies are, in other words, getting a lot more comfortable covering companies for cyber attacks and the damages that flow from those. So you for sure want to take a look at that if you in any way hold anyone's information sacred. And that, by the way, can include, if you're a health insured company, that can include your employees' health information, which is protected by HIPAA, of course. That can be one of the scariest class actions of all. So you definitely want to get cyber insurance one way or the other. Now, how about kidnapping insurance? I bet you've never heard of this. I raised this on a call on Clubhouse the other day and no one had heard of it. But lots and lots of companies that are transnational, global, right? Companies where their executives are crossing borders a lot and going into territories that aren't always perfectly safe. Their executives are targets of kidnappers the minute they touch down in that territory. Now, these kidnappers are usually not murderers. They're not trying to kill these executives. They're trying to take their passport, which is valuable on the black market, right? They might take some jewelry, they might take other valuables, but mostly what they're looking for is the ransom for that executive. Now, companies having to regularly fork over ransom amounts to these kidnappers can get pretty exhausted with it and might pull their people off of traveling on the road, which of course cuts into revenue, or might cut corners in other ways. But if you've got kidnapping insurance, which is a regular policy that is written all over the world, well, that is meant to provide the exact ransom that these kidnappers are looking for. Now, some might say this incentivizes kidnappers, right? Because now they know these insurance policies are out there. It is what it is, right? There's two sides to the coin. At the very least, you'll be able to get your employee back. Your employee also has some safety concerns alleviated. They have peace of mind that they know their company has them to the extent they get kidnapped on the road, and they're not just going to be left for dead. Kidnapping insurance, absolutely look into it if your company crosses borders at all, okay? Representation and warranty insurance. This is one of the last things I want to get to today. Now, we've talked in previous episodes about the anatomy of a deal document, and we've talked about one of the most important and vital sections in a deal document being the representations and warranties. This is where the seller is saying, I am representing to you that these are the facts. This is the health of my company. This is where we sit. This is our status. This is the status of our real estate. This is the status of our intellectual property. This is the status of our corporate health. This is the status of our environmental concerns, right? This is where our litigation sits. I'm telling you, all of this is true. And then the buyer is entitled to rely on those reps and warranties in making its decision how much to pay and whether to buy this company. To the extent that any of those representations and warranties proves not to have been true, so it was a misrepresentation, a false representation, and the buyer finds out about that post-closing, they've got a certain period of time to sue for breach of contract, to sue for breach of representation and warranty. That can result in millions, sometimes billions of dollars worth of damages, because the buyer is saying, look, I bought this company because I thought it had no litigation. That's what you represented to me, for example. Turns out it had two significant pieces of litigation on the horizon. They were just claims. They hadn't yet been filed, but they turned into huge pieces of litigation. I lost billions when I had to pay out on these post-closing. Seller, you misrepresented. I want some money back. More and more sellers and buyers are getting very comfortable with reps and warranties, which previously were incredibly scary on both sides, because insurance carriers are issuing rep and warranty insurance. Buyers usually pay for these policies, and they can file a claim against the insurance policy to the extent that the seller misrepresented something, something was missed. The buyer can then file a claim with the policy and know that the money is absolutely there, and it doesn't have to worry about going after the seller for that money. A lot of times this comes off the purchase price because it's something the buyer has to pay for, right? But the seller is usually perfectly fine with that because they have some certainty that even if they missed something in their own self-diligence and they represented something that wasn't true, they failed to disclose it in the disclosure schedules, there's this insurance policy as a safety net. The process is usually pretty easy. The insurance company obviously wants to come out and diligence the seller, usually on its own, just to make sure that it isn't insuring a complete dog, right? And there's all sorts of exclusions that happen. Like I said, if something is set forth on the disclosure schedules, the insurance company usually isn't going to cover that because that's a known risk. That is a known loss already, and that's not something insurance companies insure for. So if you are making a representation, again, back to the litigation, we have 3 pieces of litigation that are ongoing. The insurance company won't insure for damages coming out of those pieces of litigation because the seller knows about it, has disclosed it, and the buyer is walking into the deal aware of those risks. It's the litigation that the seller wasn't aware of, the litigation that the seller isn't disclosing out of negligence, not out of malintent, that the insurance policy is designed to cover. There's all sorts of other exclusions. I think it's too much in the micro details to get into for this episode, but I think you understand after I've told you about the dangers and significance of reps and warranties, how incredibly important rep and warranty insurance, which is also a relatively new beast, can be on both sides of a transaction. Now, one thing I want to mention before we end this session today, which is workers' comp. So you have one employee, you're going to have workers' comp insurance, right? That can be incredibly expensive to the extent that you've had claims in the past, to the extent that you've had injuries, to the extent that you're a manufacturing entity, by the way. Even if you have a totally clean bill of health, that can be an incredibly expensive insurance policy because they know that you're going to be making all sorts of claims because people do get injured on the job when it's a manufacturing industry, when it's a manufacturing company. Now, over the years, you will build up just the nature of the beast, and it's something that exists with workers' comp and with no other insurance. You will build up collateral. Every year, you will have to put more and more collateral into the kitty, so to speak, with the insurer in order to continue to prop up your workers' comp. It's almost like being self-insured. Did you know that after a certain period of time, you can actually hire someone to go and try to rip some of that collateral back? We're talking about tens of millions of dollars that you may have even forgotten about that's sitting with that workers' comp carrier. And to the extent that you've had a nice clean bill of health, to the extent that you've shown that you are preempting a lot of the risk that exists in the nature of your business, then the workers' comp insurer will negotiate with you to release some of that collateral. We actually did it at American Apparel. We got tens of millions of dollars back at a time when the company was in a liquidity crunch, and it really helped us. And it was something I had never known that you could do before. So that's a little bonus tip for you guys. Listen, I hope you enjoyed this episode. Please do subscribe to my YouTube channel and hit the little notification button so you don't miss future episodes. And I'll see you next time from the Office of the CEO.